Ever wondered why certain price levels seem to have a magnetic pull, attracting the price of a security time and time again? This, my friends, is the fascinating world of support and resistance. These are the crucial price points on any securities chart where we expect the maximum amount of buying or selling. In essence, they're the stages where a pause or a reversal of a prevailing trend is most likely to occur. But what's the logic behind them? It's as simple as demand and supply. Remember the golden rule of trading, buy low and sell high? This is precisely where support and resistance come into play. You either buy at support and sell at resistance, or vice versa. Most traders, irrespective of their trading style, consider these concepts vital. So, support and resistance are not just lines on a chart, they are the key indicators of the tug-of-war between buyers and sellers. Now let's dive deeper into the concept of support. Imagine a trapeze artist soaring through the air with a safety net beneath them. This safety net is like the support level in trading, providing a cushion that halts the price from falling further. It's a pivotal concept in understanding market dynamics. In the world of trading, support refers to a price level or zone below the current market price, where buying interest is strong enough to overcome selling pressure. As a result, the price decline is halted and the price may begin to rise again. This happens because as the price gets closer and closer to the support level, more buyers become interested in buying and fewer people are willing to sell. To put it simply, the support level is where buyers start to outnumber sellers, creating an upward pressure on prices. This is why it's called support, as it's essentially supporting the price from falling any further. Support can manifest in two forms: a single price level or a zone. When we refer to a single price level, it means that the price seems to bounce off a specific numeric value. On the other hand, a zone refers to a range of prices where the price tends to halt its decline and start rising. The support level is an essential tool for traders as it provides a reference point indicating where the price has consistently risen in the past. By identifying these levels, traders can make informed decisions about when to enter or exit a trade. However, it's crucial to remember that support levels are not set in stone. They are merely tools used to predict potential price movements. Sometimes prices can break through these levels, usually due to a shift in market sentiment or major news events. Although support levels can be a valuable tool in a trader's arsenal, they should always be used in conjunction with other indicators and strategies to increase the chances of successful trading. The support level is like a safety net, catching the falling price and providing a point of rebound. Knowing what support is only half the battle. The real trick is knowing how to find it. Welcome to the world of technical analysis, where we go beyond the surface to understand the nitty-gritty of trading. Let's dive deep into how to plot support level or zone. The first step is to look at the historical price data. This is where the story of any security begins. You can use a candlestick chart or an OHLC, open, high, low, close bar chart, with the candlestick chart being a personal preference for many due to its simplicity and comprehensive nature. Remember, a line chart isn't recommended as it overlooks the open, high and low prices of a trading day. Once you've got your chart, it's time to identify the extreme lows. These are the price points or zones where the price of a security turns in an upward direction more frequently. It's a bit like looking for footprints in the sand, indicating where the price has reversed its downward journey and started climbing up. Now it's time to mark all the low touch points. These are the points where the price has bounced back from its downward trend. This step is akin to joining the dots in a puzzle, where each dot represents a moment of upward reversal. The final step is to connect these touch points. This is where the magic happens. When you join these points, you create a line or a zone that symbolically represents the support level. This line or zone is the fortress that holds the price from dipping further, a beacon that attracts buyers to step in and reverse the price direction. As you go through these steps, keep in mind that support can either be a single price level, a definite line in the sand, or a zone, a broader region of price reversal. It's a bit like identifying a specific address or a neighborhood. Remember, practice makes perfect. The more you practice identifying and plotting support levels, the better you get. So keep honing your skills, keep exploring the charts, and keep finding those support levels. Your journey to becoming a skilled trader is well underway. If support is the floor, then resistance is the ceiling. Let's unravel the concept of resistance. Resistance in the world of finance acts like a ceiling that prevents the price of a security from rising further. It's the point at which the supply or selling pressure outweighs the demand or buying pressure. When this happens, the price stops climbing and may even start to drop. Picture this. The demand for a security is on the rise, and so is its price. Buyers are eagerly buying and sellers are happily selling, but as the price reaches a certain level, something changes. The sellers start to outnumber the buyers. The sellers, sensing an opportunity to cash in, flood the market with the security. Consequently, the price stops its upward journey, and unable to break the ceiling, it may even start to fall. That, in essence, is resistance. Resistance appears or forms above the current market price of a security. Like support, resistance can either be a single price level or a zone. The more frequently the price touches a particular level and bounces back, the stronger that resistance is considered to be. So why does resistance happen? It's all down to human psychology. When the price of a security reaches a level where it has previously fallen, those who bought at that level before and saw the price drop may decide to sell to break even. This increases the supply and creates resistance, but remember, resistance isn't impenetrable. Sometimes the price can break through the resistance level. When this happens, the resistance level can flip and become a new support level. This phenomenon is known as a breakout. And just like support, resistance gives us a reference point. It shows us where the most repetitive selling has happened in the past, and where it's likely to happen again in the future. It's a crucial technical level from a market participant's point of view. Resistance is like a barrier, stopping the price from soaring too high and causing it to bounce back. Just like with support, knowing resistance is one thing, being able to find it on a chart is another. So let's dive right into how to identify and plot the resistance level or zone on a chart. Step 1. Study the historical price data. To plot resistance, we'll need to look at the past price data of a particular security. The choice of chart is crucial here. A candlestick or an OHLC bar chart is preferred, as they provide a wealth of information, including open, high, low, and closing prices for each trading day. Step 2. Identify extreme highs. We're searching for price points or zones where the price of a security has frequently reversed in a downward direction. Remember, a price point refers to a specific price at which there's been a sharp reversal in price. A price zone, on the other hand, is an area where the price gets stuck after a brief upward move. Step 3. Mark all the high touch points. Once you've identified the extreme highs, it's time to mark these on the chart. These are the points that will connect to form the resistance level or zone. Step 4. Connect all the touch points. Draw a line connecting all the high touch points you've marked. This line represents the resistance level or zone. It's important to remember that resistance levels can be horizontal, sloping upwards or sloping downwards depending on the trend. And there you have it. You've now plotted the resistance level or zone. It's a process that involves a bit of practice. But once you get the hang of it, it becomes second nature. Resistance levels, much like support levels, provide us with a reference point where the most repetitive selling supply has happened in the past and is likely to happen again in the future. It's a crucial technical level from a market participant's point of view. With support and resistance in your toolkit, you're well on your way to making more informed trading decisions. So what are the key points to remember about support and resistance? Let's rewind a bit. Support and resistance are critical price points on a securities chart, where the maximum buying or selling is expected. They mark the potential pause or reversal of a prevailing trend guided by the age-old principle of demand and supply. Remember, support is the level at which the price of a security doesn't fall further, thanks to sufficient demand. It always appears below the current market price. On the flip side, resistance is the level at which the price doesn't rise further due to enough supply. It always appears above the current market price. Plotting these levels or zones isn't rocket science. Start by looking at historical price data. Identify extreme lows or highs, mark all touch points and connect them. And there you have it, a comprehensive look at support and resistance, the pillars of technical analysis. Happy trading!